Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Christopher Lento. He's over 20 years of experience in multifamily ownership, management, and investing. Chris's background is in mechanical engineering from Carnegie Mellon, and he also received professional development training at Boston University and MIT. His firm, EM Capital, focuses on acquiring and repositioning multifamily assets throughout the Southeast United States. Christopher, thank you so much for coming on today.
Yeah, thanks for having me. I'm looking forward to a good conversation.
Yeah, it's going to be great. Give us a little background on yourself, both personally and professionally, prior to getting involved in investing in real estate and primarily multifamily.
Yeah, sure. So as you mentioned, I graduated with a mechanical engineering degree and started working for an aerospace company right out of college. And almost right away, I started investing in small apartment complexes in the Boston area. So, shortly after I moved into my first rental, I was kind of interested in like who I was renting from and why my rent was so high and how do you get into this business. And then I bought a 3-family in a kind of lower income neighborhood, not far from where I lived in the Boston area. And then that's where I started my kind of real estate career. In parallel, I worked in the defense industry for 17 years and grew my portfolio kind of as I worked, very, not passively, man. I bought properties and I managed them, but it was not a main focus. It was sort of like a side activity. And then in 2017, I had my first kid, and it sort of triggered me on what kind of life I wanted to have. And, my career was growing rapidly and I was doing a lot of traveling, and I decided, and it had been in the back of my mind for quite a while, how to transition over to this full time. So that was what made the switch.
What was your first property? What town was that? I'm originally from New England, Connecticut area. What was your first property? Where was it located?
It was a 3-family with an illegal in-law apartment in the basement in East Boston, which is where the airport is.
Okay, I gotcha. All right. Yeah, no, that's interesting. Yeah, it's interesting to hear about low-income areas of Boston because of everything, of all the years of going there and being there and having friends that live there, and how everything has just gotten extremely expensive.
Yeah.
You know what I mean?
Low income is probably not the best way to say it. At the time, in the early 2000s, it was a bit of a rougher neighborhood. It's certainly changed dramatically since then.
Yeah, it's funny because my father-in-law he lived for in the 60s or early 70s or something in West Roxbury. And then I had a friend that lived there 30, 40 years later. And I was like, is this the same? He's like, I'm going to get bagels or something. The car got stolen.
West Roxbury is really nice now. Yeah.
And I lived with a buddy, he lived in a dumpster kind of 3-family. And they're like, oh, they're selling this thing for $1 million after I moved out or something. And
well, there's just not a lot of supply in Boston. So the rents are very high. Even in not great areas, the rents are high.
And then getting in the Southie, people used to say that's it. And then I go down there and it's it's like they're Brooklyn. You know what I mean? All these, it's like the hipsters going down there. I see people that were at the Cape Shoreline the weekend before that are now living in South. And you're like, okay, this is completely different from Murphy's Law from 20 years ago. You know what I mean?
Murphy's Law is still there though. I think it might be coming down, but it's still there.
No, but that's your quintessential Southie establishment, I would say. But anyway, as I digress. But so when you did that first property that you were working on, that first 3-family, which is I started in 3 families as well in central Connecticut. So it's obviously something that is a lot of supply and it's an easy way of dipping your toe into the water of investing. You know what I mean? What did you really learn from that investment?
I learned a lot of things. I sort of learned, what it's like. So because I did everything, right? I funded the deal, I bought it, I managed it myself. So I started learning about what dealing with renters is like. What kind of excuses you get, what kind of relationships are positive, what are negative. What I was always relatively handy. So just what sort of repairs and maintenance you have to do and what that costs, and interfacing with vendors but I think I learned a lot of things that were valuable and were sort of grunt work at the time. But now that I have a much bigger portfolio, I think those are valuable because I can call on that experience and I just know, how things work and what it would take to replace it and what rough costs are. I mean, there's been inflation, but when someone's like, oh yeah, it was $3,500 to replace the water heater. That doesn't make any sense to me.
Even in Boston. Yeah.
Right. What's going on, And then the tenant experience, just interfacing with the residents and understanding, the value of keeping someone in place versus raising rents to the max and, turnover and just kind of all the nuts and bolts of property management and asset management kind of roll together.
Yeah, that's true. That's right. You have like the tenant management, which is like a whole different thing. When I did it and I was house hacking, you have the tenant management portion of it. And then also on it, you have that property management, like actually like the physical property management of like repairing stuff and dealing with contractors and all that kind of, or all the fun that goes in with that. But yeah, you do learn a lot. And I started like in C class, which it sounds like how you started. And it was just one of those things where it's like, yep, it's a different way of working with tenants. You're just not getting like a straight check right on the first. You know what I mean? It's a different experience of working with people, but it's priceless, I feel. I mean, from those first 2 properties, I self-managed some properties for like the first 6 years or something. And it was priceless. I mean, the amount of knowledge you learned about information about contracting, dealing with tenants, everything like that. And it helps you being just a better active investor, but also a better passive investor. Because when you hear people that have never self-managed properties, it always makes me like a little nervous, because I think that's like the nuts and bolts of real estate investing.
I mean, I think there's a balance, right, of getting the experts to do the stuff that they're expert at. But I also think there's a value in understanding at a certain level what those things are, right? Like, I'm not a fan of just handing a contract to my lawyer and being like, just do this. Like, I read it. I get the gist. I sort of know what I think about it, and then I rely on their expertise. And I think property management's similar, right? Like just saying like, oh, you handle all of this. I don't need to know about it. I'll just look at the financial statement at the end of the month. I think there's a risk to that, right? You're putting a lot of trust without understanding it. I think I also learned to deal with people that are not necessarily honest, right? Like in the engineering world, all your stuff has to work at the end of the day. There's going to be a test. There's going to be a launch, whatever it is. So you tend to get a lot of literal people who are very direct and honest. And then, I had some terrible tenants my first couple of years that, were paying me like $40 a day, like from their waitering tips. And I was like, how did I get into this? Like, how do I get out of this? Do I believe them? Really convincing stories about why they're where they are. It was just a whole new way to interface that I had to learn.
Yeah. When the stories start, that's when you know you're in trouble.
Yep.
Yeah.
And they're good. They're convincing, especially face to face,
Yeah, they've been doing them. That's, we were like, maybe I should check those references. No, but that's one of the things that I've never called a reference in my life. I don't think I ever will. I feel like that's an easy way of just defrauding the whole system. You know what I mean? It's like, you can't put someone's name on here and just call it. I don't know. But whole different thing. I digress. But anyway, the whole thing is about, you went full time. I think you said, did you say 2017 you went full time into real estate?
2017 was like where I was in the transition, but 2018 was when I quit my job and went full time.
What were some of those challenges you had to overcome? I mean, that's a big thing. You had a child. You people relying on you, and you're making that transition from job W-2 to real estate full time. I mean, what were the challenges you had to overcome? With yourself, with your business, and obviously with people that were relying on you.
Yeah, no, certainly, it felt like a big risk, but at the same time, there was a very solid backup plan, right? Like, I had a good reputation in my industry. I didn't burn any bridges. People were quite shocked that I was leaving. Like, it wasn't like I was going to a competitor. I had like, oh, would a raise help? Or I'm like, I'm looking for something different, So I could always have gone back. I still probably could. So it was a risk, but it had really only like an ego downside. Right. Like, if I had to go back after a year, it would have hurt personally, but it wouldn't have been the end of the world. So it was one, kind of realizing that, because it felt like I was jumping off a bridge, but in reality I wasn't. And then, I had some investments in multiple cash flowing properties, and I had some fair amount of assets, and I gave myself sort of a runway. Like, this is what has to happen in a year for me to feel comfortable that this is going to work, and really just wrapping my head around that there wasn't going to be a check coming in every 2 weeks, and that it was going to be lumpy, and it was going to take a while to pan out, and just kind of having confidence in myself, keep educating myself. I joined a coaching program almost right away to keep some kind of structure in my day. I mean, I still, got up, took a shower, went to work at 8:30 in the morning. I kind of treat it like a 9-to-5 job, just because I was so used to that, and that helped a lot. But it was a mental transition, certainly.
Yeah, I would imagine so. I imagine it was a big one. But so let's kind of like turn to right now to what you're doing. Like, what is your current investment strategy and criteria for investing at EM Capital? What are you guys looking at, and like kind of the markets you guys are focusing on?
So we almost exclusively focus on the Southeast, so North Carolina down to Northern Florida, and the major markets. So we want to be in a 200,000 plus person population center. So those are the Raleighs, the Charlottes, Atlanta. We have a couple properties in Columbia, South Carolina. And the reason for that is that's where a lot of population's growing. So, a lot of people are moving from the Northeast, from the Midwest down to the Southeast. They're also moving to Texas. They're also moving to Arizona. I'm in Boston. I think there's enough population density east of the Mississippi. Keeps it in my time zone. I can get down to all my properties and back in a day if I have to. And I think there's a value in focusing, right? Like anybody who tells you they're looking at every market, in my opinion, is not looking at any market, because how do you know those markets? How much time are you wasting learning a new market every single time you have to underwrite something? So, we're really just focused on right now, Atlanta, Charlotte, Raleigh, and Columbia. We feel we know those markets. We have relationships in those markets, and the population's growing significantly, which can really solve a lot of problems. I mean, I think you can find a good deal in any market, but when the population's growing, it's sort of like the tide's coming in, and oversupply gets absorbed. So that's really where we like to focus. And then as far as our investment thesis, we're looking for mid 80s and newer. The trend is definitely towards newer properties. I mean, equity is looking for newer properties to invest in. Lenders give you a lot better terms on newer properties. But we want a value add component. We want some way where we're improving the value of the property in a tangible way. Now, that being said, good deals do come along that really are stabilized, and you can just get them at a good price for a variety of reasons. And we're open to those as well. But the focus is really on value add. So, which is tough right now. The value add market is changing.
Yeah, it's getting a lot more expensive to renovate apartments. I think it's going 2x or 3x what we used to. You know what I mean? To do like a platinum unit and like C-class. We sold our last C-class in 2023, and like you getting into newer assets. And 1985 is turning out to be old for us. You know what I mean? That's like our oldest one now. But now it's like, all right, like let's try to get that up to the 90s, because you've got those bones for people listening, the bones of the properties, all this stuff that has to be done. And then we find that there was like a lot of shoddy construction in the 70s and 80s. There just was. And then you got to deal with lead and all this other stuff. But galvanized piping, aluminum wiring, these different things that I just don't want any part of. And with insurance going up like insane everywhere, it's something that you don't want to give your insurance company another reason to ding you again, or just not write the policy, right? Or renew it.
Right. And I also find that like you're saying, like mid 80s, just the layouts weren't what people want today.
True. Yeah.
So like in the late 80s, you could find 2-bedroom, 2-bath apartments. So you could renovate those and make them nice 2-bedroom, 2-bath apartments. But in the late 70s, a lot of those 2 bedrooms are 1 bath. And there's really nothing you can do about that. You can make it as nice as you want, but when 2 roommates are looking for that apartment, they're like, oh, we got to share a bathroom. Like across the street, I can have my own bathroom. And that's a big difference that's hard to overcome with amenities or granite countertops.
Yeah, that functional obsolescence, it goes from being inside the apartment with like low ceilings, like you said, weird doors, weird rooms, which is all I did when it was like older 100-year-old 3-family properties, right? You know what I mean? When they changed all these used to be wealthy homes, and in the 60s they made them the 3 families, and they're obviously just 3 ones, right? Or 2 ones, whatever they were. But it's like parking, these different things you don't even think about with properties that you have this issue with before. Everybody's got 2 cars now. Every bedroom needs you know what I mean? You know what I mean? And then it's like, it's not just 1 car per unit. It's like, we need 1 car per bedroom pretty much. You know what I mean? Because it's like of how this works. And those things you just can't change. You might not be able to change at all, or if you can, they're extremely cost prohibitive. So it's, again, it doesn't pencil. And that's, you then get a discount on the property, but then you're passing that discount along when you sell it, but also you're passing along to your tenants when you're renting it. And at the end of the day, as my dad would say, we wouldn't buy properties without parking, because you get a less than ideal tenant, let's just say. And that's kind of how I learned about it too. And that's what I kind of see, you know what I mean? If they don't have a car and you're all the way out here, it's a different thing if we're buying in the center of the city, you know what I mean? But in most places in America, 99% of the places, you need to have a car to get around in America.
Yeah, absolutely. Yeah, that's what's nice about the Southeast. I mean, the Southeast was built around the car, right? So every complex has big parking lots, and that's rarely an issue.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. So tell us about, Chris, how you differentiate your firm from other operators buying the same target markets? Because obviously, like you said, you might have to, as I've seen from different value-add operators, they're changing towards more of like a management kind of a value-add type thing, finding out where there's mismanagement, right? Versus just putting in dollars, raising rent kind of a thing, really going in there and seeing if there's inefficiencies. How are you guys out there differentiating yourself from other people that are looking for the same deals or similar deals that are in your same buy box in those markets?
I think we really differentiate ourselves on our track record of executing. We've pushed through some very difficult deals in very difficult times in the market, and we've executed. We haven't bailed. We have a reputation of, all right, hurdle one gets thrown up. Let's get creative. How can we get through it? Now we get another one. And these things happen. And sometimes it's very easy to say, you know what, we're out. We don't want to risk this hard money, or we don't want to deal with this issue. And we have a group that really looks for creative solutions and tries to work to get things closed and to not waste people's time. And I think that helps, when it's down to a couple different groups and they're looking to say, all right, maybe they don't have quite the highest price, but they closed this tough deal. And yet this high price, we don't know them. We haven't seen them before. So I think reputation of execution, differentiates us on the seller side. And then, I think just execution. My personal focus is asset management and operations. And I bring a lot of that to kind of my investors and what I talk about. And, there's a lot of different aspects of multifamily investing. And I think the core of it is operations. And then, obviously you got to find them and you have to finance them. But really what's making the money for this whole machine is the operation.
Yeah, that's for sure. Yeah, when you're getting down to that property management, it makes or breaks the deal, and it's totally true. You know what I mean? Yeah, that's it's difficult, like you were saying, to raise money these days. I was talking to a partner of mine a day or two ago, and he's telling me that he had 2 deals working with partners, and they both fell out because they could not. They couldn't raise the money for it. You know what I mean? They had some of their partners that were coming on to help them raise money, fell through, and they weren't able to do it. So it's your broker. You have to make sure when you're bringing this to your seller, to your client, hey, they can actually close on this deal. I mean, it's a super important thing to keep their face, because if they can't, they suggest someone and they don't close, I mean, they're not going to get the next listing from that person.
Right.
So you mentioned, I believe, 4 markets in the Southeast that you're interested, or your guys are working in actively. How important is it for syndicators to kind of spread out into new markets and, focus on a handful of markets, however you guys do it? Why not just focus on 1 market or 2 markets? What have you guys found over the years?
Yeah, if a market's big enough, you can probably just focus on it. Maybe like in Atlanta, or like if you're New York metro kind of thing. But what you end up finding is that there's only so many properties in your buy box trading in a given market. And if that volume is not enough to kind of keep you underwriting and looking at deals and making transactions, you have to spread out. You have to be able to look at 100 deals to make 5 offers to get 1 hopefully under contract. So if there's not 100 deals a year in your market, well, then you're unlikely to even get 1. So some of it's just a numbers game. And then, like I said, too many markets, you have to know the market. You have to have and also establishing a network in the market, knowing the property managers, knowing the vendors. We are working on we just got our third property in Atlanta metro area, kind of a similar region, under contract. And there's already benefits of having these two existing properties and then adding this third. We can have a roving maintenance kind of support guy that can go to all these properties. We have the same lawn company across the portfolio. There's just a value in having that network and knowing who to reach out to when there's an issue. So that really matters.
So you guys are operating in 4 different markets. Can you tell us kind of how you've successfully asset managed properties out of state in multiple different states and markets?
Yeah. So where possible, we like to use the same property management company. So for 3 of our assets in the Southeast, we've used one kind of big regional company that is very valuable because we can kind of have the same VPs that we deal with, similar processes and procedures, kind of leverage across. But then where we, they don't cover every market we're in. So, then we have other property management companies that handle our other assets. And I would say, get a good relationship with the property management company, triangulate. So try to find other resources in the area that you can get to kind of check on the property when you're not down there. So whether it's a contractor relationship that you've established or a broker, like, hey, drive by this property once a month and just check on it. Because they want to keep that relationship with you as well. So they're happy to do that. And then a lot of communication. So we like to know, the names and ideally get the cell phone numbers of the maintenance techs and the on-site property manager for all the properties and kind of establish a rapport with them. We talk to them once a week through a video call where we go through our financials for every property, but then even off cycle, just call them, see how it's going, kind of get them on a call where their regional is not on the call and say, hey, anything going on that I should know about? Because there's, if you have 3 people on a call, in addition to you, maybe they're reluctant to tell you something that's concerning them. But if you can establish a personal relationship with like the maintenance lead, you can say, hey, what, if you had $1,000 to spend on a tool, could you save any money? They're like, oh, I've wanted an auger for years that I could clear the main drains with. And I don't know why we keep paying these guys $700 to come and do it. They're like, oh, we can do that. We can 100% buy you an auger, or a power washer or whatever. But they just don't maybe convey that to the person that you speak to once a week, and it doesn't get funneled up. So trying to get a personal connection with the on-site staff.
That makes sense. When I had a small portfolio in Connecticut before I sold it in 2022, and you talk to, I would have the handyman would have my number, one of the ones, and he would just text me afterwards. He goes, I was told to fix this, but there's like 2 other things here. Like, do you want me to go back and ask about this, or you can do? I'm like, no, just go and fix it. Because they want to keep expenses down over here in the office, but they don't see the property over here. And you're like, I understand everything. I appreciate everybody doing their job, but it's like, listen, if you're down there and like one of the steps in the basement isn't right, fix it. You know what I mean? If there's an issue, like if there's a lot, go fix it. You know what I mean? Like this should be like common, but I understand like people, you know what I mean? They're trying to keep everything down and, everything's penciled. So, but yeah, so kind of forward, I mean, after so many years, decades of investing and being involved with multifamily real estate, what are some of the common mistakes you see, real estate investors make? Maybe they're new or experienced.
I think being over aggressive on assumptions and underwriting. Like your underwriting has to work. Like that's it, right? Like once you buy it, there's only so much you could do to execute your business plan if your business plan was not correct to start with. So it's so easy to be like, well, maybe the exit cap rate is a little bit lower. And that's like a big lever, right? Like you move that number and your whole deal looks better. Maybe we can squeeze out a little more rent growth. And, and there's a balance, right? If you're overly conservative, you'll never close a deal. But if you're, overly aggressive, you'll never have an investor that invests with you a second time because the deals aren't going to work unless you're lucky, right? So I think that really understanding all the assumptions that go into underwriting and convincing yourself that they're the right level, not too aggressive, but not too conservative, and knowing where you're just like, hey, I can't move this and we'll move on to the next deal.
Chris, what advice would you have for, offer to new investors saying that they want to dip their toe and get started? They have a W-2, kind of like similar how you got started with that first 3 family. What would you suggest to them if they were in a similar position years before you?
I would say think about how involved they want to be, right? Like, I'm a syndicator. I'd love to say invest with a syndicator and learn something. That's one way to do it. If you want to be very passive, and we can put you on the calls, but you're going to learn as much as you sort of want to learn. If you actually want to like be eventually an active, I would say just go buy something. Like go figure out what you're comfortable with. If it's a single family, if it's a condo, if it's a 2-family, ideally like kind of near you, and do something, like put some offers in, figure out, just be active. And maybe, you're working with a couple brokers and you talk to some lenders and you're like, you know what? I don't really like, this is too much. At least you've learned that. And if you're like, hey, I kind of like this, how this is working, then buy a small property and run it. Get some kind of hands-on experience. And if that's not the kind of person you are, then start looking at reputable syndicators or maybe people that need just an equity partner. So maybe not a syndication, but a smaller, say like 3-family where someone needs equity and you can, have a vote and be more actively involved, but they're the knowledgeable one kind of running the show.
Yeah. You have people that want passive income and then they actively buy a property and like, hold on.
Right. It's different. It's very different.
This is not what it, this is not what
owning a multifamily is not a passive investment.
It's a small business. That's right. Yeah.
It's a small business. Right.
Yeah. So Chris, thank you so much for coming on today. How can listeners learn more about you and your corporation?
You can find my company information at emcapitalgroup.com. And I'm very active on LinkedIn. Shoot me a message. We can set up a call and I can, tell you more about the company and what we're working on. We got 2 big opportunities right now. So yeah, things have been busy.
Well, that's great to hear. Well, Chris, thank you so much for coming on today and looking forward to connecting with you here in the near future.
Yeah, I appreciate it. Thanks.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.